Hello everyone, I'm Marty and welcome to my June 2025 real estate market update. Sorry, I'm a couple of days behind schedule. I just got back from Boston for our daughter's graduation. Wonderful trip. Congrats, Nat. And I got back to our TV and it had died, so we had to get a brand new TV in here. It just got installed today, and I'm ready to get this data out to you, so apologies for the slight delay. Let's jump right into the stats that I've got to show you today. Here's our June 2025 table, and here comes the sun. We've all been waiting for this, and it's being reflected in the market. Now, bear in mind, these stats are from the end of May, so this is reflecting what's happened in May. When we look at year-over-year sales activity, of course, we're down from May of last year when that market peaked out. We're down 23, 10%, 19% for three different products. The prices are slightly below where we were this time last year because they had already started to fall in May. And last month, virtually no change, 1.2% drop in houses, 0.4% townhomes and half duplexes, and 0.7% in apartment condos. So not a lot of change in pricing, but this month things are really starting to get busy. We'll talk about why, what's happening out there, why is there this sudden resurgence in the market. We'll get into that in more detail. So first of all, let's talk about what's hot, what's not, what happened in May over the last month. And just getting back to that last slide, if we look at the sales ratio, which is a metric I use to gain how active we are in various product categories, if we've got an absorption rate in the market of less than 11%, we're in a buyer's market, that's favoring the buyer, and there's downward pressure on pricing. If we're between 12 and 20%, we're in a balanced market. And if we're greater than 21%, that's those white hot markets where we get multiple offers, prices are bid up, and there's upward pressure on pricing. So those are the three different markets we look at. If we jump in right away and look at detached houses, Vancouver West Side, there's the year so far. We've been hovering in that buyer's market territory over the last few months. Let's see what's happened in May. No change. We're at 7% for our sales ratio, still in that buyer's market territory. And if we look at condos, townhomes for last month, you can see we were pretty well in that mid-balanced market range throughout the year. If we look at this last month, again, no change at 17% in solid balanced market territory for condos, townhomes, west side. And if you look at condos, townhomes downtown, you can see lower end of the balanced market for the year. Bring up those stats for this past month. We're at 11%, so slight drop in activity downtown for condos, townhomes last month, just at the top end of that buyer's market category. Let's pop over to the east side, detached houses on the east side. You can see started out balanced, just dipped into that buyer's market territory as we got into spring, thanks to all the activity worldwide and down south of our border. For this past month for houses east side, we are at 11%, so just at that upper end of buyer's market territory. And of course, if we're looking at condos and townhomes on the east side, that was very active this year. May stats for April were actually at 18%. Let's bring up those stats for May. We're actually at 18% still for condos, townhomes, Vancouver east side, and that's the high end of the balanced market range for that particular product in Vancouver. Now, more importantly, where are we getting into? Across BC, we've seen we're in that balanced market area right at the bottom for most product throughout the province. What is happening with prices? So we'll dip into that. If we look at our average pricing, again, there's our peak pricing we had over the last year and year before. We're about, give or take, 10% below that peak pricing, 5% in some categories, 10% in others when we're looking at Greater Vancouver in general. If we're looking at some product on the west side specifically, we're more closer to that 5% range. So we'll go into more detail in that. Looking at the 5-year trend, there's the peaks over the last 5 years, and we can see overall we're down about that 5 to 10% as well. So what's happening in the burbs? No surprise. When we're looking at detached first, the monthly variances, April to May, you can see we've had a slowdown a little bit further out. South Surrey, Pitt Meadows, Cloverdale, Port Coquitlam, Burnaby, and Tsawwassen were down. Everywhere else close to the west side actually picked up in Vancouver throughout. And if we go to attached product, you can see we had a pretty well a slowdown across the board. A few areas, outliers, where we've had an increase in activity last month. So what's happening now in June? If we look at overall with respect to prices, what can we expect? Here's our peak back in 2022. Here's our peak last year. We're about here. Where are prices going to be going? So that's what everybody's asking. Let's pop into the next slide so we can get into our forecasting, because we've all had enough at the beginning of 2025. Since the inauguration down south, we've had a lot of turmoil, a lot of global uncertainty, and people aren't making major investments when that's going on. Now that has kind of reeled back. We've got a great leader now here in Canada who understands the dynamic, seems to have formed a good relationship, so that fear of that ongoing tariff war, apart from some of the recent developments, has subsided significantly. And many of the people who are planning to make a move and have held back for the last few months are starting to jump in. My phone's been ringing off the hook. We're listing up lots of property coming online this month, and a lot of buyers who are waiting to buy are now jumping back into the market because those rates have come down as well. We're getting great rates. Some 4 or 5 year product hovering around 4%. We'll get into that in a little more detail as well. So let's look at what's happening now in our market and forecasting for the summer and into fall. If we look at our drivers again, our driver enhancers, market enhancers are in green, deterrents are in red, transitioning in orange. The very first thing that I look at is consumer confidence. And to sum it up, after an exhausting 3 months, consumers are now coming out. The weather's improving. They're having children. They got to get bigger places. They have been waiting for months to jump into that market and buy that real estate. They're out looking now. So we're seeing that pent-up demand from earlier in the year, which is quite interesting. Normally you see those curves much higher. They're pushed down. That demand has to be met, and they are starting to come out. So the consumer confidence is coming back. That uncertainty has dissipated somewhat. That's good news. It's still not green. Inflation and the economy are still green. The economy is still holding. Inflation's doing very well. We'll look at that closer shortly. Cost of borrowing has come down, as I mentioned. 3, 4, 5 year mortgages are much better than they were beginning of the year and last year. So that's more appealing to the buyers as well. So when you got more buyers out there, you've got more product. When you have more product, you have more sellers. It keeps going in a circle, and the inventory levels are starting to increase steadily. They're not going crazy, nice and steady, and that's what we want as market enhancers. The last thing we're waiting for is that confidence to come back in the market fully. But here's the sun. It's coming out. It's a beautiful day. People are getting excited, and June has already taken off as quite a busy month. And let's jump into why that is. Unemployment is up a little bit, 6.4% for BC, 7% for Canada. So we're getting some increase there in the unemployment rate. Retail sales are still up. They're still strong. That's good news. The GDP is holding steady. This data is a few months old, so we haven't shown any drops there yet. But there is the GDP and the economy, and of course inflation, everything that Tiff Macklem, the Bank of Canada, is watching before they make any interest rate changes. And as you know, and I'll get into that, the overnight rate did stay constant in the last announcement. Residential sales, so home sale activity year over year fell by about 9.6%. You can see that just volume of sales has been down. No surprise. We all know what's been happening since the beginning of the year. If we look at rental rates, we're at $3.4 per square foot. Last month we were at 3.12, so the rental rates are starting to recover. I always look at that as a good barometer of what's happening in the market. When they start to come up, we start to see an appreciation in pricing as well. There's the breakdown throughout the Lower Mainland, and you can see average rent for a one-bedroom furnished, very close to the average rent for unfurnished, about $2,300 to $2,400 a month. Commercial leading indicators. So commercial real estate activity shows an improved environment for commercial real estate investors. That's a good sign. When investors start to buy commercial real estate, they're looking into the future. There's money coming back into the market there. We can see that's a surge of activity here over the last few months. Good news. And the consumer confidence. I don't know how that got in there. That's a photo of me. Looks like doing the Camino on a very happy sunny day. So that's kind of the feeling we're getting out there in the market. Here's the consumer confidence, the S&P 500. Again, a very good barometer for what's happening in the market. Wow, look what happened in May. Incredible. We're almost back to where we were in the beginning of the year. So it's climbed its way back. That index is a strong indicator that investors are out there investing and bringing back that market activity that we like to see. So there's also a new government program. It's the GST rebate program. It was just announced May 27th. That's really good news for first-time buyers who are buying new product. Under $1 million, that's about $50,000 in GST that they're actually going to get back as a rebate. You have to pay it as part of the transaction, but it gets rebated back to you. And that discount from that rebate from $1 million to $1.5 million is on a sliding scale up to $1.5 million. So for example, if you bought something at $1.4 million, you would still get 20% of your GST back, which would be $10,000. So that is a great, great program to help stimulate that pre-sale market, that new product market, getting into it. Nice program the government's announced to kind of stimulate the real estate market as well. It's always good news to have a program like that. And other good news, Canada is a sovereign nation. Now, we all know that. We had King Charles visiting. He gave a great speech. I love when he said the true north is indeed strong and free, sending a very strong message to our neighbors. Canada's not for sale, just like the White House. And it was really nice to see. It really brought us all together. It gave consumers, again, confidence. Hey, we're not alone here. We've got all sorts of friends around the world, and this is a nice show of that. I thought it was a great, timely visit by the King to Canada. So that's good news. We all love this. So just moving on past that, getting down to the data again, inflation. Wow, 1.7%. How did that happen? We're even below that happiness band. Last month it was at 2.3%. There's Tiff Macklem holding the market in his hands there. He decided, weighing everything together, to hold that overnight rate the same at 2.75%. Now, the thought behind that is that he's holding those drops, and it could be as many as 2 or 3 drops still coming this year of maybe 25 basis points each. We could be hitting a 2% overnight target rate as we proceed to the end of the year, but he's holding that in his pocket for when he really needs it. When our economy might need a boost, as long as inflation's behaving, he's going to pull those out and start bringing them in. So there's a very positive forecast of this rate dropping even further. So that's good news. And if we look at the 12-month change in the consumer price index, we can see that that has come down. So inflation's behaving extremely well. And there's that band of happiness you saw at the end. We're actually below that, so there's a lot of room to play there. We are pretty well in sync with the neighbors. We don't want to get too different from them in the overnight rates or the inflation rate, because inflation behaves negatively when there's a big discrepancy between the two countries. We don't want that to happen. We're kind of on the verge of getting close to that now, so that's something that the Bank of Canada is also watching closely. So the cost of borrowing, of course, has come down. And if we look at the mortgage rate forecasters, so variable rates, the way I look at it, they're a function of the Bank of Canada overnight rate. So every time Tiff Macklem lowers that Bank of Canada rate, the variable rates pretty well drop automatically. They follow suit. So that happens immediately. And the forecast is that the Bank of Canada has maybe 3 more rate lowerings this year, depending on the momentum of the economy, if it does lose momentum. And he weighs that against the upside risks to inflation increasing, but potentially fading because we're at 1.7%. This overnight rate could drop to 2%. So that's possible that our variable rates might drop another 0.75% before the end of the year. So that's good news on the variable rates. So we're looking at some potential big drops. If we look at the fixed rates are a little bit more complicated. I barely understand it, but basically from what I gather, they're a function of the economy and the bond yields. So, in other words, when the economy weakens, the bond yields drop. We get less investors, and that bond yield starts to drop. When the bond yields drop, fixed mortgage rates drop. So, the Canadian bond yields are expected to remain relatively stable or experience a slight decline. And of course, that's influenced by the monetary policy decisions, i.e. the overnight lending rate, and the economic contingents, and of course, by fiscal factors. That means only if the banks want to lower the fixed rates will they, and they'll weigh that against everything they're looking at. So from what we can see, fixed rates are also going to drop ever so slightly this year. So it's a smaller green arrow. You see the size difference there. There's no direct correlation. But what I'm saying is, if that economy does weaken and the bond yields do drop ever so slightly and the banks think it's a good idea, those fixed rates are also going to drop. So mortgage rate forecast overall looking pretty good. Let's go on. There's the happy face. There's what's happened with the rates. Whoa, there's last year, and here's this year. So that's looking pretty promising. Depends on a number of factors, but fairly promising for the rest of the year. Let's look at the buying power for today's cats. If we look at our cats, we're looking at, say, a 3.99% mortgage, which would be a great deal right now. If you're borrowing $100,000 for 25 years, that monthly rate is going to be $527 per 100K. So when we're out looking at $1 million properties, you know your monthly cost is going to be $5,270 a month for $1 million, and you can factor that by your 100K. That is a little bit lower than where we were last month at $531. So things are looking better from the lending point of view and mortgage rates. So this is kind of a fun fact. Big banks hold 80% of the mortgages. Here's all the banks in Canada: RBC, TD Scotia, CIBC, BMO, and Desjardins. If you add all of those up and put a line there as of January 31st, the total residential real estate loans in Canada is $2.42 trillion, only held by these banks, large institutions. The 6 banks plus Desjardins hold 80% of the market share of all the mortgages in Canada. Wow, I thought that was kind of interesting. Rather than our friends to the south, who have dozens, hundreds actually, of banks where all those mortgages are being held. Inventory levels. We got to look at that, because when they change dramatically up or down, the prices change. So if you look at detached houses, west side, we're looking at inventory here in red. We're seeing a gradual increase in product. That's healthy. That's what we want. We don't want a dramatic change either way. That's the same story for the west side. Attached condos and townhomes, we're getting an increase in inventory. We're at 1,151 units right now, up from 1,121 last month. If we look at the east side, same story, gradual increase in inventory, very healthy, and that inventory is getting eaten up by that increased buyer demand. And east side attached, same story as well. We're getting that increase in inventory, but nothing dramatic. Across BC, you can see there's been an increase in inventory almost since the summer of 2023, up and down a little bit, but a big increase in products coming on the line throughout the province. Okay, what's next for prices? The main reason most of you are watching. Let's forecast the main things that we're looking at. Oh, here's the wall of success. I guess these are all of our sellers this past month. We've got a lot of happy sellers. We've sold product because we've had multiple offers, and pretty well all of our sales, if it's done right, we're pricing accurately and we're marketing properly, the buyers are coming out and they are buying products. So we've got a lot of happy sellers this past month. This is an interesting graph that I looked at for across BC. If we look at the sales trend, you can see the sales trend in the dark color versus the price growth. You can see the price growth and shrinkage here, and the uncertainty. As soon as we get that sales momentum changing, you can see when uncertainty is in the mix, the larger that orange bar is, the lower the sales trend. The lower the uncertainty, you can see that activity starts to grow. I thought that was kind of a neat breakdown. If we look at that and the rates, you can see when the rates were high, the sales were down. When the rates are getting smaller, the sales all of a sudden jumped up. That's one of the bigger influences that we're watching, and that's why I'm always reporting on what's happening with those variable and fixed rates, because they're a big impact on our market. So basically, if I was to summarize this whole update in one word, it's uncertainty is out and some certainty, well, actually two words, is in. We are seeing some certainty in this whole despair we experienced the first few months coming into focus, and people are saying, heck, we're not waiting anymore, let's go out and buy our new home. And that's starting to happen. So that's good news. So in conclusion, our market is impacted by mortgage rates, inventory, consumer demand. Bank of Canada's likely to continue to support the economy by up to 3 more rate drops. Hopefully that's the case. That's certainly going to keep things active, so that's a big green check mark. Inventory levels are climbing at a reasonable rate. That's a big green check mark. We have a new Prime Minister doing, I believe, I don't want to get political, but an excellent job. His relationship with the president down south seems to be good, probably better than most world leaders' relationships right now. We've had King Charles visit us. There's a lot of good stuff happening here in our country, and things are looking a lot better than they did even a couple of months ago. The threat of the U.S. tariffs do continue, and if they do, the Canadian economy will, of course, weaken, but inflation, if it remains stable, the Bank of Canada will continue with the rate cut. So again, there's all those factors that the Bank of Canada looks at before they drop the rates. But if that inflation remains stable and we do get a little bit of a softer economy because of the little tariff struggles that are going on, that means those rates are going to drop. That's a big deal. And the overnight policy rates will immediately lower the variable rate mortgages. And if the bond yields decline, as I went into earlier, then the fixed rates will also drop. So they're all kind of intertwined. We have that new GST program. That's going to stimulate the pre-sale and new product market for GST. And the big one, that pent-up buyer demand, I can't emphasize how important that is. When people aren't buying for 4, 5, 6 months, there's a demand that's there, insatiable, that has to come out at some point, and that is now ready to start spilling out. It may not flow out all at once, but it's starting to build, so we are seeing those buyers out there taking advantage of it. So basically, what I'm seeing is more buyers are entering the market, and sellers who are waiting are beginning to list their homes. I listed 2 more today. I listed 2 last week, 3 last week. So they're starting to all come onto the market for this sort of renewed consumer confidence that we're seeing out there, that refreshing sun is out attitude. So that's really helping. So what I'm forecasting is I think you can expect a gradual and growing increase in the market activity as we move through the summer, with prices stabilizing and beginning to recover. So that's my forecast. I think we're going to have a very good summer. That curve of activity has been pretty flat over the last 5 months. You're going to have to see that demand come out. I think we're about to see that. Very good. Oh, and the fun page, yes, I think we're almost full in this, but I do have another senior seminar coming on, where are we here? June 26th at 6 p.m. We've got the music playing, we've got the wine out, there's food coming in. We have 28 seats. I think we've got a couple left from an upcoming downsizing seminar. They're a lot of fun. If you haven't signed up yet and you want to come on out. We do it all on the big screen. Meet other seniors who are downsizing. It's a great, great event. And that, my friends, is my June 2025 market update. You can watch this video anytime or send it to your friends on YouTube, Instagram, or Facebook. And of course, you can listen to it on YouTube Music, Apple Podcasts, or Spotify. I'm Marty Pospisil. Thank you very much for joining me for this month's June 2025 market update.